It's Sunday, February 1st, 2026, and silver is sitting in that uneasy, quiet moment after a storm. Friday's sell-off didn't just shake out weak hands. It rewired positioning, leverage, and risk for the week ahead. Right now, the question is not, will silver go back up? The question is, where is the real floor? The level where forced selling ends and real buying begins, before the London Open. This video is a practical, voice-only strategy guide. No hype, no hero calls. Just 3 price zones, 3 decision rules, and how to protect your account if the market tries a second flush. Quick context in plain English. Silver ran parabolic into the 120s. Then it dropped hard into the mid-80s. That kind of move creates 2 things at the same time: bargain hunters and trapped holders. When the market reopens into a major session, both groups collide. That collision is why Sunday night and the London Open can produce gap and trap moves, a sudden push lower that punishes early buyers, then snaps back when the real liquidity shows up. As of the last hour, spot silver is hovering around 84 to 60. That's the current battleground, but the projected deeper liquidity pocket sits lower, in the $75 to $79 range, and below that is the ugly zone, the area where the move stops being a correction and starts becoming account damage. Let's lay out the 3 levels. Level 1 is the immediate pivot, $84 to $85.50. This is where price is hovering now, and it's where the market will tell you if Friday's liquidation was enough. Here's the rule. Don't trade the noise. Trade the confirmation. If you see a clean 15-minute close below $84 after London wakes up, that is your first warning that the market is still flushing leverage. Not a guarantee, a warning. What do you do with that warning? You do nothing aggressive. You don't catch the knife at $84 because you feel smart. You wait for the next zone. Level 1 is for reading the tape, not for betting the week. Level 2 is the institutional floor, $75 to $79. This is the zone that matters. If you're a Western trader trying to find the real floor, this is the area where larger value buyers are more likely to step in, because it aligns with a major structure support from earlier in the year and a commonly watched Fibonacci support zone around the high 70s. But listen carefully. The best signal here is not price touches the zone. The best signal is the behavior inside the zone. You're looking for a wick down into $75, $79 that gets bought back fast. That means price dips, finds real bids, and snaps back above the zone, ideally within the same hour. That is the classic liquidity grab pattern. The market hunt stops, forces capitulation, then reverses as stronger money absorbs the panic. If we get that kind of wick and reclaim, that is the bottom is in signal for the week. Not because it feels good, but because the market proved there was real demand waiting. If instead, price enters $75 to $79 and just sits there heavy, grinding, unable to bounce, that's not a floor yet. That's a warning that buyers are not confident, and the market may keep searching. Level 3 is the ugly zone, sub $70. This is the line in the sand. Below $70, the correction can turn into a failed breakout, and the damage becomes psychological as much as technical. In simple terms, below $70, the market stops being a 2-day shock and starts becoming a trend shift for the medium term. Here's your risk rule. Don't argue with sub $70. If you are trading leverage, this is hard stop territory. If you are a long-term holder, sub $70 is the zone where you stop adding and start protecting capital until the market stabilizes. Now, here's the Black Sunday playbook, the part you can actually use. Step 1. Decide your role before the London Open. Are you a short-term trader trying to survive volatility, or a value buyer trying to scale in without being trapped? Your role decides your rules. If you're a short-term trader, your job is simple. Protect the account. That means smaller size, wider patience, and zero need to predict. You wait for confirmation at level 1, and you don't go heavy until level 2 proves demand. If you're a value buyer, your job is also simple. Buy where fear peaks, but only when the market confirms absorption. That means your best entry is not at $84. It is in the $75, $79 pocket, but only after you see the wick and reclaim behavior. Step 2. Map your 3 outcomes for the London Open. Outcome A. London opens strong and silver holds above $84. In this case, level 1 becomes support and you shift from defense to patience. You let the market build a base. You don't chase. You wait for pullbacks that respect $84. Outcome B. London opens weak, breaks $84, and sells toward the high 70s. In this case, you stay calm. This is the scenario we are preparing for. You let the flush happen. Your attention is now fully on level 2. Outcome C. London opens weak, slices through $79 and heads toward $70. In this case, you stop looking for bargains and start looking for stability. This is not the moment to be brave. This is the moment to be disciplined. Step 3. Use a simple 3-tap approach instead of one big entry. If you plan to buy level 2, don't dump all your cash into the first touch. Think in 3 small pieces. First piece only after a sharp wick and bounce. Second piece only after price holds above the zone for at least an hour. Third piece only after the market forms a higher low. This prevents you from becoming the liquidity for someone else's exit. Step 4. Watch timing, not headlines. The most violent moves often happen during session handoffs, when liquidity shifts from thin to thick. The London Open is one of those moments. Another is the London to New York overlap. If a sub-$70 break happens, that overlap window is where the market can accelerate, and where you must be most careful. Now, a final point that many people miss after a crash like this. Your edge is not being right. Your edge is staying solvent long enough to be right later. Silver can be structurally bullish long-term and still punish you short-term if you trade it like a straight line. Treat this week like a reset week. Your goal is not maximum profit. Your goal is maximum survival with good optionality. Before we wrap, I want to give you a simple checklist you can run in real time, because most losses on nights like this come from emotional guessing. Checklist A. What a real breakdown looks like at level 1. A real breakdown is not one random spike under $84. A real breakdown is a clean push below $84, a failed bounce that can't reclaim $84 within the next 2 candles, and then another push lower with expanding speed. If you see that sequence, the market is advertising that it wants liquidity lower. Checklist B. What a real bottom print looks like inside level 2. A real bottom print usually has 3 features. First, a fast drop into the zone, with long lower wicks. That stops being hit. Second, an aggressive snapback above $79 or $80. That's demand showing itself. Third, a retest that holds higher than the first low. That's sellers losing control. If you only get step 1, you do not have a bottom yet. Checklist C. What a dangerous fakeout looks like. The market can bounce hard from $82 to $86 and still be weak. A dangerous fakeout is a bounce that looks powerful but happens on thin liquidity, then collapses again when the next major session arrives. That's why the London Open matters. It brings thicker participation and exposes whether the bounce is real or just air. Now let's talk about the one thing that saves accounts: position sizing. If you feel the need to make back Friday's chaos in one trade, you're already at risk. For this week, use a simple rule. Your first entry should be small enough that you can be wrong without stress. If you can't sleep with the position open, it's too big. Here's a practical way to do it. If you plan to buy level 2, imagine your total intended position is 100 units. Your first piece is 25 units after the wick and reclaim. Your second piece is 35 units after price holds and forms a base. Your last piece is 40 units only after a higher low confirms momentum. That way, if the first entry is early, you're not trapped. You're simply staged. If you are trading futures or high leverage, reduce everything further. On weeks like this, margin is not your friend. It is a timer. Your job is to trade like a professional who expects volatility, not like a gambler who expects comfort. Timing notes for Western viewers. The London Open is $8 GMT. If you can't watch live, focus on the London-New York overlap, when liquidity is thickest and reversals tend to confirm. One more trap to avoid: confusing a floor with a good price. A floor is not a number, it's a reaction. The market tells you the floor by how quickly it rejects lower prices. If price drifts through a zone like it isn't there, that zone was not support, it was hope. And remember what Friday taught us. When leverage unwinds, it doesn't ask permission. It sells whatever it can, wherever it can, until the margin pressure ends. That's why we wait for the level where selling gets absorbed. So here's the clean summary you can repeat to yourself before London opens. Level 1, $84 to $85.50 is the read. Level 2, $75 to $79 is the real test. Level 3, sub $70 is the danger zone. And the rule is simple: don't catch the knife at $84. If weakness shows up at the open, wait for the high 70s pocket. If the market wicks in and snaps back, you have a signal. If it grinds heavy or breaks sub $70, you step back and protect. This is not financial advice. It's a risk management framework for a high volatility week. If you want, comment your plan in one line: level 1, level 2, or level 3. If you're watching into the London Open, subscribe. The first hour will show the reset or deeper flush.